Welcome back to another episode of Gimme Some Truth. Today we are talking about all things Fed chair. 2026 is going to see a new Fed chair, and that is the discussion for the day. Sil, help us understand who has been nominated. We shouldn't get ahead of ourselves. Who's been nominated but not yet confirmed to be the next Fed chair?
Kevin Warsh is his name, incoming Fed chair. And so I think a pick that, I don't think it surprised a lot of people. I think I was looking at the betting odds about a week prior to the nomination. I think he was the leading candidate.
Sure.
So in a way, something that, a lot of people expected, right? So I think it was a kind of a 3-horse race between him, Waller, and Hassett, and I think he ended up, being the pick.
Didn't necessarily see a big reaction from the markets. It seemed like they kind of digested the information and kind of moved on pretty quickly.
Yeah, it was a little bit of the dollar strengthened ever so briefly. I think it was, the reaction from markets was almost like it looks like business as usual. I mean, there's some nuance that we'll talk about in his position, but I think there was a big fear. I think back to in the Bush administration when Bernanke was appointed Fed chair, some wag made the comment, well, we're just glad he didn't appoint his personal CPA. And I think that was a little bit of the okay, good. He was a Fed governor before, knows how the markets work. He's served on the committees, kind of known as a consensus builder as well. So, and I think the market as well knows that, hey, no Fed chair, if they're following kind of the Fed, is going to step in and just remake it overnight.
Yeah. Do we think he's going to have a pretty easy confirmation process? Do we think that there's a very good chance that he gets confirmed?
I mean, I think so. It's kind of hard to imagine a scenario where he wouldn't. Again, it's a very credible candidate, not a very obscure or high-risk candidate, former Fed governor.
And his name's been out there for a long time.
Right, exactly. So again, I don't expect it to be a particularly controversial process.
Yeah. Keith, what do you think in terms of where does it go the first month after, the first quarter after, the first, you know what I mean?
Yeah.
Are we going to be trying to see fireworks? Is it going to be, let me just learn the position? I mean, how do we kind of gauge that?
Yeah, I mean, I think, obviously he's going to want to hit the ground running from the position of getting to know things, but, he was last on the board 12, 13, 14 years ago now. I'm doing the math in my head. 2012 is when he left. And he left under some circumstances that were, he wasn't really happy about quantitative easing and wanted to stop that. And so I think that's going to be one of the biggest changes that we can kind of talk about there.
He was on when Bernanke was Fed chair.
Yep.
Yeah.
Appointed kind of 2008, I think, is when he started. And so from that standpoint, and we can talk more about what quantitative easing is and that sort of thing, the Fed has a difficult job. They have dual mandates. They have to look at keeping employment high, unemployment low or employment high, and then lowering inflation. And so right now they're kind of striking that balance. We've set a target announced of about 2%. I think the Fed is okay if we're running a little hotter than that, but they don't want to cross over that 3% threshold. So that will be, where the data is between now and then. We'll, kind of highlight things. There's also a big belief that we're looking at an AI productivity boom, essentially, whereby you can basically have sustained growth and not have inflation. Yeah. And full employment, have good employment numbers and not have huge inflation because, the growth in productivity. I think a little bit, this is something that back in the 90s, Greenspan advocated with looking at, the internet and so on. So it's something there that bears watching. I think, though, any Fed chair, anytime you start a new job, 1 month in,
sure,
he's learning how to turn on the computer, right, make sure his email works. Right. Does his Outlook calendar go to the right place? But all of those things.
At the same time, could he try to prove something? Could he try to go a little fast? Could he try to kind of prove that he has the merit to be in the job? I think that's always the fear.
Yeah,
as well.
I mean, I think he's got the merit to be in the job. I think, though, the very structure of the Fed means he's got to build consensus, right? Yeah. We're in our Walkner kind of book club reading a book about 1929 and just about how the Fed has always been about consensus and building that consensus, because you have 12 governors from throughout the country of different, they're responsible for their own research points. They get their data from elsewhere. So he may want to, try to prove something, but, he's working with 12, really smart people. And it's a little bit like I described, dinner at the Poniwaz house. It's, with my parents and my brother, it's 4 people and 6 opinions. So I think
I've seen that before. I've seen that movie.
Yeah. And so I think there's going to be some time lag. He may want to come in, but I think he's also smart enough to know, hey, if you want to build, don't be a bull in a China shop.
I think Keith points out 2 really important things that we should make very clear for people. The Fed's job is to keep an eye on unemployment and keep an eye on inflation. The Fed's job is not to change rates, right? I think that so often gets associated with the Fed as though it's part of its job. It is a tool that the Fed can use, speaking to those other 2 points, but it's not the Fed's job to change rates.
Well, no, I mean, you're right. Ultimately, the goal should be to control inflation, right? So interest rates are just a tool, and it's a fairly limited tool because really Fed decisions really affect a very small portion of the yield curve, right? Of the different types of rates that are out there in the market. So you're right. Ultimately, his job is about controlling inflation while keeping the economy going, right? So it's kind of his dual mandate that you alluded to earlier.
I want to get both of your opinions on what I think is almost, if I may, the undercard bout, if you will, is almost as intriguing as the main event, which is will Powell keep his position when he steps down in the Fed, or will he retire and kind of exit stage left? I mean, what are your thoughts on that, and what impact do you think that has? Because the domino effect of that decision is pretty impactful.
Yeah, you're right. I mean, and I don't know that I necessarily have a strong. My hunch is that he's going to just move on.
Okay.
But again, I have kind of no it's just a hunch. I have no insider information
Jerome
or particularly strong
either one of us, unfortunately.
Huge impact on the Fed and how the Fed behaves moving forward.
It could. I mean, and again, it's a committee decision ultimately. So, I think it's very easy to overemphasize the importance of just individual players in this game.
A single vote versus 12.
Right. Exactly.
I mean, it's fun to. It's like it's like a soap opera. Will he leave? Will he stay? I think the bigger question is going forward how quantitative easing is going to be handled, because that's where Warsh really has kind of staked his name. And I think, a couple of pieces Sil and I have shared one from the chief market analyst of StoneX on this topic. He's really anti-quantitative easing, and that's really his thing. And so, and Sil, I'd be interested in your thoughts here, how is that going to be handled? Because to my mind, quantitative tightening is really hard, because essentially you have to do it without the market noticing in some sense.
Yeah, and I think part of it is they wanted someone who kind of talked tough a little bit in the past, because I think one of the concerns with this nomination process had to do with Fed independence.
Yes.
Right. And I think by bringing in a guy like Warsh, you have someone who's credible, that has a history of being fairly hawkish, fairly conservative with some of his decisions, right? And I think that alleviates some of the concerns with Fed independence, right? And I think that's part of why we saw the dollar strengthen on the back of his nomination, right? But I think I don't think he is a kind of hardcore, let it all burn to the ground, liquidationist type, central banker either, right? I think if you look at his voting record, I think he actually voted in favor of QE2 back in the days, but he did talk about concerns having to do with the size of the Fed's balance sheet, with the Fed having too big an impact on markets and distorting prices and things like that. So he has that credibility. At the same time, some of the concerns that he voiced, they're not that controversial. I mean, I don't think any central banker, frankly, should be that enthusiastic and carefree about expanding the size of the balance sheet, with no constraints, right? So I think he has a good balance of having this kind of credibility in terms of not being too much of an easy money type of guy. But at the same time, I think he's been fairly pragmatic in the past in the way that he's made decisions and he's voted. So I think he ultimately, I don't think this is someone who would actively try to stand in the way of lower interest rates, but he also would not be particularly aggressive about, Fed intervention and particularly quantitative easing. So, I think this tells me that we're probably going to see lower interest rates. And I think the fact that you mentioned AI productivity, that's one of Warsh's also kind of convictions, is we're about to have a sort of surge in productivity. And that also plays to lower inflation, right? Because if productivity goes up, inflation should come down, right? So that should probably the only good way, so to speak, to lower inflation should be exactly that. It should be to increase productivity. And it's one of his personal beliefs, right? And so that would lead me to think that he's going to be someone who would be willing to bet on that and would be willing to lower interest rates even ahead of any of that happening, right? So I think in a way he's very hawkish and conservative when it comes to the size of the balance sheet, but he may be more dovish and willing to lower interest rates. So it's kind of a balance between the two.
Yeah, I think that's a very good point. So I think it's interesting to know how AI is going to affect this, because you're right, productivity could go up, could lead to, potentially gangbuster corporate profits, things like that. But it also could lead to higher unemployment. So it's this interesting kind of juxtaposition that they could find themselves in of an economy that's running hot, but inflation coming down, while at the same time you have unemployment, negatively affected, right? I mean, it's an interesting spot they could find themselves in.
Yeah, I mean, but I think we've lived through a similar transition, during the .com and after era, right? How often do you use a travel agent anymore, right? But employment, things shift, I think and so one of the, things, and I think a lot of people don't realize this, is we view these data centers as lasting forever. But in fact, chips burn out at an incredible rate when you're using AI. And so there'll be a lot of maintenance on these data centers. There will be, we're seeing employment being boosted by building, these data centers. So there are things there, there's some concern about entry-level jobs in white-collar fields being reduced by AI. What I've read from people studying this in more depth is that some of those gains have been overstated in terms of, there's in the news been a one-to-one correlation between AI and college graduates not finding jobs, when the truth is much more nuanced, and that it's not a clear connection there. So I think, the economy constantly changes and positions change in those markets. And I think what Sil highlighted is, I think what relieved the market in some senses, you said, well, what's going to happen for him in 3 months, 4 months? We don't know what the data is going to look like in 3 months, 4 months. And it sounds like Warsh is the sort of guy that's going to take the data into account as he develops whatever his strategy is going forward. And so if we see a spike in inflation, it's distinctly possible we won't see the rate cuts. And, and the other thing to bear in mind is the markets already had started pricing in some rate cuts. So, they do their curve, their projection for how often. And I think, they're thinking maybe over the next 1 or 2 years, interest rates could be 0.03 or 0.04% lower in the long term, right? So maybe one additional cut. I don't think he's going to step in and do a 50 basis point cut right away, because the appetite from the Fed isn't there, and you got to get the data.
Yeah. Let's end on this. I'm going to ask each of you, how are you managing money differently at all with a Warsh led Fed? Are you doing anything different in terms of either anticipatory or potentially something that may be reactionary? Anything different that you might see between now and the end of the year?
Not particularly. Again, I don't think his nomination. I mean, and we got questions about things like, oh, what does it mean for gold, for example?
Sure.
Like gold had a great run. Now that Warsh is in charge, is it like a dollar strength environment where gold's gonna go down, commodities price is gonna go down? Is there a shift in the environment? And the answer to that, to my mind, is no. Again, a lot of the move in gold, for example, happened while Kevin Warsh was the leading candidate in the betting odds, right? So it's kind of like it's not like this is all coming out of the blue, and in itself is going to lead to a change of regime. And again, I'm not saying gold is going to continue to go up eternally. It's not, right? But the point is, I don't think that in itself is enough to kind of get to the conclusion that the environment itself has changed, that we're facing a regime change. I really don't think that's the right conclusion.
Keith?
Yeah, I think the whole Federal Reserve system is set up that it's not designed to be kind of predictable and stable and understandable. I think that's one of the reasons why QE was so controversial at the time. It was a brand new kind of thing. We didn't know exactly how it would pan out. Bernanke had done quite a bit of research on the topic and knew it very, very well, but that's why. And so I think insofar as, he's an institutionalist, I think the markets will look on that in favor. And, if he maintains Fed independence, that's the key thing for him, is that Fed independence, that we're, relying on data and that sort of thing. Then I don't foresee any reason, also for the reasons that Syl identified, to radically change your view. And remember, the world is governed by other central banks as well. It's not just the U.S. story, so a lot of kind of overlapping stories. So I think, continue to looking at diversification going forward. And
yeah, I think too the data point is a very, very good one, especially when we consider the fact that we're now 5 years removed from COVID, which involved a fair amount of artificial influence by way of money into the system and things like that, which made then the data a year out from that, 2 years out from that, 3 years out from that, maybe not less valuable, but it was just hard to understand the impact of those moves and what did that mean to the data. I think we're now kind of the point where we're getting more data that's reliable, and we can look at precedents more now today than we could say 3 or 4 years ago.
One, I think as well, Jerome Powell has really tried to be plain spoken. Greenspan was deliberately opaque. Bernanke was an academic, so it took a little bit more parsing. And I think, if Powell has added anything, it's, hey, I'm speaking cleanly and plainly to the markets. And so I think that growing transparency is important as well. And again, you want a boring central banker. I don't think you want, a crazy guy running the show. And a guy who's transparent. That's what the markets want, that sort of stability. And
they say that a good sporting event is refereed well when you don't notice the referees, right? And I think that is a good way to end it. If we can have a Fed that isn't noticed as much, that's probably a good thing for everybody.
Are we skipping my upcoming golf trip?
I mean, you've had how much time now to drop this in? Syl and I have been breath.
Well, I thought you guys were going to ask me. You were curious about my life,
Like a little thing we pull and it's pink or blue. Is
yeah,
what happens?
Exactly. So I'm going to going to visit my parents down in Florida. They stay on the Atlantic side in the north, and so I'm going to visit them this weekend, and I'm going to play at Jekyll Island golf course, which Syl now probably recognizes has a significant value. That's part of the reason I wanted to go there in the creation of the Federal Reserve.
Right. So that goes back to 1913 or
1910, 1911, something
like
there.
That.
Yeah.
Long time ago.
Yeah. I have a couple of books on the history of Jekyll Island that I'll be reading on the way down to piece that together. But essentially, that's where they created the Federal Reserve. That's where they brought them all together.
Yep.
And then a senator from Virginia by the name of Glass-Steagall made the really wise and why, the idea of a consensus in the Fed. The idea was, the worry for the rest of the states was that it was just going to be governed by New York. And he was the one that came up with the idea to appoint 12 kind of regional offices and have, Fed governors throughout the country.
Well, so I have no choice but to make this a two-part, because we're going to need to hear the enlightenment that you had since being down there.
Keith came from Jekyll Island.
And here's what he has to remember. Well,
I'm going to give you an 18-hole recap. That's going to be our least watched podcast of all time. Me
to do with the
recapping my round of golf with my dad.
We'll wait in anticipation for that. Thank you so much for tuning in to another episode of Gimme Some Truth, and have a good day.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.